Welcome to the Long-Term Investor. Today, I am so happy to be joined with my office neighbor, Sara Gelsheimer, Senior Wealth Manager at Plancorp. Sara, thanks so much for joining me today.
Thanks for having me.
Now, for those of you watching on YouTube, you will see we're clearly not next door to each other at the moment, but our offices really do reside next to each other. And so I always love going to Sara with financial planning questions, personal finance questions, and the topic that we're talking about today, charitable giving questions. So Sara, I'm really excited because a lot of charitable giving people think is pretty straightforward, but you do a lot of what I would consider to be charitable planning. So more than giving, maybe you could just start us off here by talking a little bit about the difference between charitable giving versus charitable planning.
Sure. Yeah, I would say charitable giving is really just the act of giving to charity. There's nothing at all wrong with just giving to charity. But I'd say, charitable planning involves just more meaningful thought behind that. So number one, thinking about what missions really matter to you, what charities align with those missions. So really giving some intentional thought about what you want to contribute to. But then, the financial side of things is how can you do that getting the biggest bang for your buck from a tax standpoint?
And when you're working with a client, Sara, and they're thinking about starting more of an intentional plan of giving, what are some of the questions you feel like that they should be asking themselves, be asking you, be asking the charities?
Yeah, it obviously comes back to each individual's really what they're trying to accomplish. But I think the first place to start is really saying, okay, what do I actually care about? What brings me joy? What do I enjoy doing? And then again, finding the charities that align with those values. Because there are, I don't know how many tons of charities out there. And it can be overwhelming. So just starting with, okay, what do I care about? Then trying to narrow that focus and figure out the charities that might match that. Then it's, okay, what can I afford to give? And then if I can answer that question, now what's the best way to do that? Again, from a tax standpoint, from a logistics standpoint. So I feel like that's kind of the order of questions to start thinking about as you think, okay, I'd really like to start giving to charity.
Well, obviously, a lot of our clients are routinely giving to charities. Mm-hmm. Some of it's, intentional. Some of it's a little bit sporadic. Or maybe people are listening and they know they have a certain cause or area of focus that they want to support. So are there questions that you feel like they should be asking the charities directly to be ensuring that their gift is really put to good use and help achieving those goals that you're talking about?
Yeah, like I mentioned, there are so many charities that it can be completely overwhelming to even know where to start and really, figuring out how to even evaluate a charity. I know is something that I've talked to clients about. There's some really good resources. I know like GuideStar, what's the Charity Navigator is another one where they actually, they pull the 990, which is an IRS form that's public. So charities have to publicize certain information. So that's a good place to start. GuideStar and Charity Navigator pull all those 990s that they have to file with the IRS. So they can help you kind of decipher what constitutes a quote good charity. I know, a general rule of thumb is that you hope to see a charity spending about 75% or more on their mission, on programs, versus having a larger portion go to, fundraising, administrative costs. Again, it's a rule of thumb, but it's a good place to start to see if that one charity is at least giving the vast majority of their funds to the mission that they're supposed to be supporting.
That's one that I'm particularly passionate about. I've served on United Way allocations panels before and looking at different charities, and some are great fundraisers, but every dollar you give, only 60 cents ends up actually at the mission. And even then, when you're talking about giving to a United Way, I guess not to throw them under the bus, but there is a layer of their fundraising costs when you do that, as opposed to give directly to a charity, which actually I'd be interested in your opinion. Some people like to spread around gifts. Do you ever have a sense if it's better to give to a lot of different charities or to give all your money just to one place? Any sort of guidance, or when clients ask you that, how do you help them think through those decisions?
I personally, I like the idea of giving a larger sum of money to fewer charities, just making, having a bigger impact. I I certainly have clients that fall into both camps. I mean, we have clients that really do a lot with one particular charity, maybe one or two charities. They give significant amounts of money and they can actually see what those dollars are doing. It's something meaningful. But there's nothing wrong, of course, with giving to a lot of different charities as well. I mean, we've all been subject to, getting things in the mail or calls. And it's like, okay, I'll give $50, $100, a couple $100 here and there. So there's, nothing wrong with that. But in terms of significant charitable contributions, I just find that, I personally have enjoyed giving to smaller organizations that really can use that money. And I can actually see what that's actually doing. And I think a lot of our clients are in that same camp as well. I mean, I would even take it so far as to say that's not just with funds. I mean, I'd say, if there's a charity that you're really passionate about, yeah, the dollars are very meaningful, very impactful, but get involved too, volunteer, consider joining the board. I always think those are really great ways to help a charity beyond just the financial aspect of it.
The classic 3 T's of time, talent, and treasure, all very beneficial to those charities.
Now, candidly, I was really good about, fully immersing myself in the charities that I was involved with or was, really enjoyed the missions. And since children have come along, that's become a little bit more difficult. So now those charities are getting more of my treasure than my time at the moment. But, maybe one day.
Well, that is 100% the same for me. We're similar age. You have 3 young children. I have 2 children. They're young, but not quite as young as yours. I'd planned on asking you this anyways, but this seems as good of a time as any is, as both parents of young children and working with other parents of young children and grandparents, if you want to instill some charitable habits in your children, what are some of the things that you suggest doing?
Oh, I could spend a lot of time on this.
Yeah, let's do it. Dig in.
Yeah, as you mentioned, yes, I have 3 young children. My oldest is 5, and then I have a 2.5-year-old and an almost 1-year-old. So my 2 daughters, the 2 younger ones, they're not at a point yet where they can really, we can really start talking about charity. But Abe, my oldest, who's 5, I mean, we've started talking about, just little things here and there along the way. I'd say a good age to start, and I'd love to get your opinion on this too, but somewhere around age 3 or 4, I think, is an acceptable time to start having those conversations. And it doesn't have to be anything elaborate, but even just talking about, for example, we, one of the charities I've been involved with, supports people in Uganda. And so we sponsor a couple girls in Uganda. We get pictures from them and cards. And so we've just talked about how they live versus how we live, particularly when, they're talking about how they have no toys. Abe has, oh God, I have no toys. It's like, let me tell you a little bit about that. So just talking about, not everyone has the same means that we do. And so just starting those conversations at a young age, I think is helpful. Everyone's heard about the spend, save, give jars, which I think are a great way to start instilling good saving habits and giving habits in kids. So, the idea of giving them an allowance, and some portion of it has to go in each of those jars. Now I'll say too, just from personal experience, I think it was last winter, Abe got some money for his birthday or a Target gift card actually. And his favorite thing is to go targeting. So we were going targeting, and our neighborhood was collecting like hats and scarves for people without homes. And so I said, Abe, it'd be really great if you would spend a little bit of your money to buy a hat and gloves for these people that don't, have as much as we do. And, you think, gosh, I've been talking about this, and he's really a good kid. And, he's just like, no. He was like, I want to spend it all on my toys. I'm like, dang, where have I gone wrong? So, you can talk about it, but just, I would say, don't get discouraged. So, we've continued to have those conversations. I will say he did end up buying a hat and gloves, much to his dismay. But, just starting those conversations, doing little things like that, I think can go a long way when you're trying to teach kids to be thankful for what they have and realize that there are others who don't have as much, and that we can really make a difference in someone else's life. So,
well, if it makes you feel any better, I know that we were really good about the allowance and having the spend, save, share jars with our oldest, Tommy, who's 9.5 now. And we never really executed that well on the share, even though he was always putting it in there. But what eventually happened is the school had a coat and hat drive, and so he ended up contributing there. And we said, oh my gosh, yeah, we finally have a use for all this share money. Our 5.5-year-old Joey has an allowance, but the concept hasn't sunk in with him as much. And as you know, as you keep having more kids, you get a little bit lazier with the implementation of some of the things you want to do. I also would tell people that adopting a family can be a really fun way for kids to pick out things. And like you said, you'd mentioned people abroad. We actually just spent time in the Dominican Republic. We visited a public school. We visited a family in the jungle, and our oldest walked away saying, oh my gosh, my life is so great. And that was a wonderful opportunity. And he said, can we please make sure we send money to people like this when we get home? And so I think it's, yes, as you mentioned, there's a lot of actual giving of money and going and doing things, but just opening your children and your grandchildren's eyes up to these different experiences. Their world, they especially for children, they forget how big the world can be sometimes.
Oh, for sure. And you never know when they are going to change or flip the script. I was not super thrilled about it at the moment, but then, we were talking again about the girls in Uganda the other day, and he was like, gosh, I can't believe they essentially turn trash. I was talking about how they make soccer balls literally from trash. And so he's like, okay, I'm going to go get them a toy from my toy bin, which, to be fair, he grabbed a Hot Wheel, and he has about 110 Hot Wheels. So, but it was a start, and so at some point, all the things that you instill in them will pay off. So it's just not getting discouraged when it doesn't happen overnight. But there are so many cool things. I love that idea of bringing them along on a mission trip, or even just, things here in our neighborhood of, serving meals, doing things like that we can truly show them that there is more in this world than what their little world is. So I love that. Really strong point. You do not have to leave the country to find people who need help. So volunteering, always a plus, and kids love to help. Yeah, I mean, my 5-year-old just wants to turn off the lights. If he knows he's really hurt, helping a real person, that's going to blow his mind and make him happy. And I know that, so we're talking a little bit holistically about charitable giving. I'd love to dig into some of the tax stuff, because I know this is where you are quite savvy yourself. Maybe just hitting some of the basics that people need to know. Like when you give a charitable gift, what are a couple items you absolutely need to know? So, in December of 2017, the Tax Cuts and Jobs Act was passed. And one of the provisions of that, it basically doubled the standard deduction. So the standard deduction in 2022 for married filing jointly is almost $26,000. So that's a given. Everybody gets that $26,000 standard deduction. So this has left a lot fewer people to itemize their deductions. So in order to itemize, you have to surpass the standard deduction, or it doesn't make sense. So there are a few things that count towards itemized deductions. So one of them is unreimbursed medical and dental expenses, but those have to be in excess of 7.5% of your adjusted gross income. So for the vast majority of people, they've got nothing in that category. And then you've got state and local taxes. So state income taxes, your property, your real estate taxes, all of that gets bucketed into one group, but it's capped at $10,000. Okay, so $10,000 for that bucket. And then the other items that count are mortgage interest and charitable contributions. So, those have to add up to a decent amount of money before you even get to itemize your deductions. So I'm going to walk through an example because I feel like that's always easier. So let's just say there's a married couple. They give $5,000 per year to charity. Let's say they've got their $10,000 in state and local taxes, so they've met the cap on that. And then they've got $10,000 of mortgage interest. Okay, so if we add all that up, that is $25,000. Well, the standard deduction is $26,000. So in this instance, yeah, all these things that they have, great, but they don't get any benefit for them. They already are, they're just taking the standard deduction. So one of the things, I talk to a lot of clients about is, giving $5,000 a year, that's significant. I mean, that's a good sum of money to give. And I should step back and say, in all of this, I always reiterate that don't ever let the tax tail wag the dog. I mean, you shouldn't be doing you shouldn't be giving a charitable gift purely for the tax benefit. There's so much more to it than that. But if you're going to give, you might as well do it in the most tax efficient way. So let's go back to our example. We've got $5,000 a year that they're giving to charity. So in this particular example, we'd say, okay, you're giving $5,000 per year. How about you consider bunching 4 years of contributions into 1 year? So there's $20,000 that you would give to charity in this year. So now you've got your $20,000 charity, $10,000 state and local taxes, and $10,000 mortgage interest. So now you're itemizing, and that's $40,000 instead of the $26,000 standard deduction. So, that's an instance where people are already giving, and a lot of people didn't even realize they weren't itemizing their deductions. Like, what? I don't have to keep all these receipts? I'm like, well, you can keep them, but they're, not being accounted for on your tax return. I mean, it's something like 90% of taxpayers don't itemize. So the vast majority are just taking the standard deduction.
That's a big
which
number.
Is pretty mind-blowing. Yeah, it's crazy.
Well, and so the one thing I actually do love whenever I see somebody use a donor advised fund is the idea that even if they are spreading around their gifts, let's use your $5,000 example. Let's say that couple was giving $1,000 to 5 different charities, and they fund a donor advised fund with 4 years of gifts. So $20,000 all at once. That is one tax receipt for one tax return that you have to keep track of. It's actually that alone, anything that makes tax filing easier is a win in my book. But the donor advised fund gets used frequently, both for those who are charitably inclined, as well as those who are just trying to lower their income threshold for whatever reason, be it sale of a business, exercise of equity options, Roth conversions, et cetera. Even though I did just rattle up off a couple use cases, I mean, what would you say are some ideal times to be using a donor advised fund, even if they are some of those same things I just rattled off?
Yeah, I mean, certainly, I would say even outside of that, just in my example of normal giving, that's an instance where a donor advised fund can make sense. So just to kind of take a step back and really explain what a donor advised fund is, it's essentially you put money into the fund in a particular year, and it can be cash or it can be appreciated securities, which I can touch on in a second, but that's really the best way to fund a donor advised fund. But you put the money into the fund and you get the tax deduction in that calendar year. So in this, in my example, you put the $20,000 in today. Well, you get to deduct that, or that counts on your 2022 tax return. But I can still continue to make grants from that donor advised fund to various charities over the next 4 years, or really however long. I mean, can go into perpetuity. So it's a great vehicle to use when you do want to do charitable bunching, bunching several years worth of donations into 1 year, because you can make that donation, get the tax deduction, and to your point, have one tax receipt, which is a beautiful thing. And then you get to make, grants from that over time. So yeah, those donor advised contributions can be great just for regular giving, especially when you're trying to bunch it into several years. But then, like you said, I mean, if there's a particularly high tax year from sale of a business, we've been doing lots of Roth conversions for clients while the market's been down, so we're able to take advantage of that. So any particular year where your income is higher than it generally is, I mean, it's a great time to have a higher itemized deduction. And a good way to do that is through a donor advised fund, for sure. And
you mentioned giving securities versus cash, whether your phone, and you'd mentioned, giving the securities is beneficial regardless, whether it's to a donor advised fund or directly to the charity. Can you just explain that real briefly for us?
Sure. Given that the standard deduction is so high, and like I said, 90% of people are not even itemizing their deductions. So when they're writing those checks here and there, I mean, they're not getting any tax benefit. Again, still great to do. I want charities being like, hey, well, people are not giving, but it's great to do, but you're not getting a tax benefit. So even if you don't, again, like bunch them in several years and end up itemizing, if you're giving, let's say $1,000 a year to charity, you might as well, you're not going to get the tax deduction, and that's fine, but you might as well gift shares of mutual funds or stocks that have appreciated in value directly to the charity. So let's just say you bought ABC fund for $20 a share. It's now worth $50 a share. And as long as you've held it for at least a year, you can actually transfer those shares directly to a charity. And that $30 of appreciation, nobody pays that capital gains tax on. So yeah, you're not getting a deduction, an itemized deduction for it, but at least you're using property that has some capital gain that you're not going to have to be taxed on. So, if I've got a client who gives $1,000 in a year, we'll say if they've got a joint, brokerage account or a trust account that has assets that are invested, we will look for whatever fund is most appreciated, and we will do the paperwork to have that fund moved over to that charity. And then they've got their extra $1,000 in their pocket, or they put that back into their joint account and they repurchase that fund, which is now at $50 a share. So they basically reset their cost basis. So again, it's just another way of getting some tax benefit, even if you're taking the standard deduction.
So both the gifting of securities and donor advised funds are pretty frequently used strategies at Plancorp. I was hoping, though, you could talk about some of the other strategies we're using with retirees or even people who maybe have an estate tax liability or want to have some source of income as a result of this.
Mm-hmm. Yeah. So one of the things we're doing a lot of, particularly right now at year end, is doing what are called qualified charitable distributions. So let's take a step back. When you turn 72, you are mandated to start taking required minimum distributions from your IRA, 401k, your retirement accounts. Those dollars have never been taxed before, so the government's like, hey, it's about time we start getting some tax money. So you have to pull out a certain amount from those accounts, and it's all taxed as ordinary income. So that's when you have to start taking those. Now, at 70 and a half is when you used to have to start taking those required minimum distributions. And one of the recent tax law changes, I won't get into the details of that, but basically at 70 and a half, you can actually start doing what are called these qualified charitable distributions. So it's basically giving dollars from your IRA account directly to a charity. So similar to giving appreciated securities, this is money that will never be taxed because you didn't pay tax on it when it came into the account. And if you transfer it to a 501c3, they're not going to pay tax on it either. So it's a great way to give money. So again, you can start that at 70 and a half. So as soon as you turn 70 and a half, you can start making those gifts from your IRA. Now you don't have a required minimum distribution yet, so you're not required to pull money from your IRA necessarily. But if you're charitably inclined, there is no reason not to give from that IRA account because it's at least using tax deferred dollars.
And to chime in there, so if you are taking RMDs, you're going to be paying ordinary income tax on them. Mm-hmm. So not only are you avoiding that, you're shrinking what your future RMDs liability will be. So that's really quite a swift sort of tax planning strategy based on the most recent tax laws that, I think is really important for people to be thinking about this time of year. In terms of those who are looking into more of those estate planning strategies, what are some things that you often look at there?
So one of the things we've done many times is open a charitable remainder trust, so CRT. So that's basically a vehicle where you can put, again, highly appreciated securities into this trust. And basically you receive an income stream from it over a certain amount of time. And at the end of this time frame, the remaining amount goes to a charity. So you get an upfront tax deduction. So again, it's a good thing to do if you're in a high income year. So that's just another strategy we've seen people take advantage of. Again, when they're in a high income year, they've got some assets that are highly appreciated and they want to avoid paying that capital gain on those assets. That can be a really great strategy to employ. And I want to make one more quick statement on the QCD is that there is a cap. So you can't give more than $100,000 to charity in any given year. So I wanted to make that call out. But for example, if your required minimum distribution is $150,000 that you have to take, you can give $100 of that to charity, and then you're only, reporting that $50,000 of ordinary income on your tax return. But it is capped at $100,000. So, wanted to point that out.
Good to know. So now that we've kind of nailed down a lot of the tax planning side of things, we're recording this just before Thanksgiving, and as the year end approaches, people are going to start having more of these conversations. I'm curious, Sara, what sort of conversations you've been having with your clients just on this topic broadly?
Sure. We have, a handful of clients that come in this time of year, towards year end with their whole families, which is really, it's probably one of my favorite things that I get to be a part of, are these family meetings where they have their kids come to the meeting and we talk about, just general financial concepts and what their roles would be in their parents' estate planning and things like that. But for a lot of these meetings, we also get into charity. And so I have a client in particular who has a pretty sizable donor advised fund balance. So they had a really high tax year, so they put a lot of dollars into a donor advised fund a couple of years ago. And they're now over 70 and a half, so they're taking their qualified charitable distribution. So theoretically, this donor advised fund is just sitting there that will then be passed to their kids so that their kids can decide how to make, what charities to make donations from this donor advised account. So they've started allocating a certain piece of their donor advised fund balance to their kids, or letting their kids decide how they get to spend those dollars, to what charities they get to spend those dollars. And so during those family meetings, they come and they say, here's the charity that I researched, and here's why I think they would be a great recipient of this money. So that's, a pretty cool thing to start doing for your kids if you've got the means to do that. And, I'll give a plug for, she's actually a St. Louis author, but Carol Weisman wrote a book called Raising Charitable Children. And it's got some really awesome ideas for, it talks a lot about these family meetings, which is something, like similar to what we are already doing. Just give some ideas and some, basically like kind of agenda and questions to consider if that's something that you're interested in. So that's a really great idea. And then, I'd say just, I would say that this is a great opportunity to go back to kids, of just talking about, what you're grateful for. I mean, this time of year, it's a great opportunity to start having those conversations if you haven't already. And then, Christmas is coming up. And so I've already got family members who are saying, what should we get your kids for Christmas? And, going back to this book, I mean, Carol Weisman, she gives some really great ideas to think outside the box in terms of, gifts for kids. So I know it gave a story about a grandma who said, instead of buying me a gift for my birthday or for Christmas, I want you to go do something nice for someone and then draw a picture of it and then send it to me and tell me about it. I was like, well, that's a pretty cool idea. I don't think you're going to get away with giving that to your children of just, hey, I made a donation in your name. So that may not be the best idea for the only gift that you give your kids, because you don't want charity to be, they have a negative connotation with that. But maybe in addition to the toys that you're going to give them, consider, doing something with the zoo if they love the zoo, or the museums that they enjoy. So just, maybe think about, as we go into that holiday season and gift giving, to think outside the box and maybe instill some good values in the way you give gifts this year.
Well, Sara, this has been fantastic. I really appreciate you taking the time to both educate our audience and re-educate me on some of these important issues. I'm definitely going to link to that book in the show notes. And if anybody here is listening, wants to get in touch with Sara, I will have all her information, a link to her page on the show notes at thelongterminvestor.com. Or you can just go straight to plancorp.com. You can find her real easily. You can even click a button that says Meet with Sara, and I think you get to schedule something right on her calendar. So by all means, if you have more questions, both on the tax planning side, the charitable giving side, we'd love for you to reach out to Sara. And if you're watching us on YouTube or listening to us on Apple or Spotify, please leave us comments, reviews. We always appreciate that. That helps us better discover what it is that we want to be talking about next. Until next time, though, to long-term investing.